if you don't have your intentions dialed in, it's really easy to get caught up in a business that you actually don't like. Welcome to Entree Real Estate, where we turn the complexities of real estate into clear, actionable steps for building generational wealth. I've invested into different types of real estate all over the United States, and I run a thriving real estate fund. Join me as we document the entrepreneurial journey of scaling businesses and transforming the lives of tens of thousands of people around the world. Let's turn your real estate dreams into reality. Buckle up, because this is the start of something truly incredible. My name is Devin Robinson, and welcome to Entree Real Estate. What's up, everybody, and welcome to another episode of Entree Real Estate. Today's guest is I don't know, Jake. I would consider us good friends. I really like you, Jake. Jake is a guy that I met him in my mastermind and really have come to just love the guy. I think he's extremely kind. And just like when it comes to real estate, I look up to him a ton because he does so much with creative finance. I'm often surprised, like when my wife's, oh yeah, Jake owns 100 units of this. I'm like, what? Jake is the freaking man. And just an absolute go-giver, just really serves well. And it's really funny. My wife is his transaction coordinator. So Jake is really generous with his time, his experience, what he knows, and is just crushing it out in Texas and also some in Colorado now.
Correct. Yeah.
Awesome, man. Jake, thanks so much for being on the show, man. I would love to even just start off, I'd love to hear a little bit about yourself. I know you're married, you live in Colorado, but you don't necessarily operate fully in Colorado. So if you could share a little bit about your journey that's gotten you to where you are today, I would love to dive into that. That'd be awesome.
Yeah, absolutely. Thanks for having me. I'm really excited too. This is
heck yeah.
So I grew up in Austin, went to UT. When I was in my late 20s, I moved to Amarillo because that's where my family is originally from. They've been in Amarillo since the 1800s. And I moved there to take over the management of my family's cattle ranch. So something unique about me, we still own and operate my family's cattle ranch and north of Amarillo, the Texas Panhandle.
Okay, so you live, hold on, I'm sorry. So that you live in Texas and you operate a cattle ranch. I've got one picture in my brain of what that looks like, and I'm sure it is not what the reality of it is. Jake, I just feel like, Jake, you've probably gone through there, cowboy hat on a horse, just riding through that ranch. But what is what is like the operational function of a cattle ranch? Because I'm not even quite sure. And what constitutes a ranch? 1 acre, 2 acres, 1,000 acres? What does all of that look like?
Sure. It's funny. We've got friends up here in Colorado. They're from New Jersey, and they have no idea what that even means. What is a cattle ranch? So they're always asking me the same kind of questions. But if you were to take the pickup trucks out of the photos, it would be, we do everything the same way that you did in the 1800s. So everything is still horseback. We still rope calves, drag them to fire, brand, all that kind of crazy stuff that you might see in the movies or on, I don't know, now there's a lot of TV shows about that kind of stuff.
There is. That's all.
And so it relates to real estate in a way because it's a covered land play, I guess you could say. Cattle ranches are typically not that profitable unless you're at a huge scale. However, you are mildly profitable and you're maintaining a very valuable asset in the land. I consider myself to be a steward of the land. My job is to take care of it. We might own it for right now, but it goes on to future generations. And it's also part of the commons. Like we have not just a financial stewardship, but we also have an stewardship as well. It's a very sensitive riparian area. There's creeks and live water, and we try to take good care of it. And while also making a little bit of money and doing fun stuff with horses and four-wheelers and helicopters and all that kind of fun stuff.
Oh, shoot, you brought out helicopters. Okay, now we're getting crazy. So, what I love about it is what you said is like, you're just being a good steward of it for future generations. So it sounds like it's more of a legacy play than it is a financial play for you. So you're not like, I'm going to take it, I'm going to subdivide it, and then I'm going to build an apartment complex on it. You're like, no, I'm leaving this for my kids and my kids' kids. Because really quickly, I have a pretty strong conviction that I strongly believe that my kids will not have the ability to purchase a property when they get older because it's all going to be corporate owned America. And so unless you have properties for your children or land for your children, they'll never have the opportunity to own anything like large physical assets like that. So it sounds like it's more legacy for you than it is like currency now.
Yeah, and I believe that I have a macro belief in land and real estate, and that's how generational wealth is created. And so it's really important for me to be a good steward of it for my kids. But it's also something I'm passionate about. I even though I live in Colorado and the ranch is back in Texas, I still go back once a month and stay at the ranch and check on everything while also checking on all of our real estate.
Nice. Now, do you I feel like you can have a very large ranch house because you could build whatever you want out there.
Sure.
Now, you did go back though, and I'm very curious, and I don't know how much you want to talk about this, but I know that there was a large incident on the ranch recently. And how does that affect the ranch, like the profitability of the ranch? And then honestly, the amount of effort and energy you have to now put into the ranch that takes you away from other things that you're doing.
No, it's a good question. And years ago, we partnered with some very large operators in the Texas Panhandle. These are people who manage hundreds and hundreds of thousands of acres of ranch land, tens of thousands of head of cattle.
Wow.
They really have the economies of scale for marketing. And so they handle the day-to-day of the cow care, right? So I don't have to worry at all about that part of the ranch. I manage all the other parts of the ranch, which is infrastructure, legal, accounting, all that kind. Recently, we did have a huge wildfire at the ranch that burned about 20% of the ranch, started by a power line during a windstorm. We lost 6 head of cattle, and it will take effectively 80% of the ranch out of production, because if you think about, you have 20% of the land burned, but those are larger pastures, and so we have to take all of those pastures out of production in order to rest them from fire. Now we've had flooding.
I hear about that.
Yeah, it is what it is.
And I guess that's just the nature of it, because if it's been going on since 1800s, it's not the first time this stuff has happened, and then just Mother Nature takes its course, and it just continues to recycle over time. Very interesting. Okay, I love that. Now, aside from cattle ranching, you do operate in Texas, and in Texas you have multifamily, single family, all of that stuff. And then in Colorado, you're beginning to flip in Colorado.
Yeah, we also have a little bit of stuff in Louisiana and a little bit of stuff in Michigan.
By choice, by design, or it just happened that way?
Both. So the way I got into real estate was that I inherited a fourplex in New Orleans. And I was living in Texas at the time. The house is in an amazing location in the Marigny district in New Orleans. If anybody out there knows New Orleans, it's right next to the French Quarter. Great location. My uncle was living in it at the time that he passed away, and I inherited the property. We'd never been there. We showed up, my wife and I took a plane to New Orleans, showed up with a bag of keys and an address, and the house was in terrible condition. I love my uncle to death, but he had not taken good care of his properties. And so we began managing a rehab remotely from Texas in New Orleans, rehab the entire property, rented out part of it long-term, part of it Airbnb, and kept part of it for ourselves as a personal vacation home. And that was how I got started. It was by necessity. And the stuff in Michigan was by choice. My wife is actually from Michigan, so we've bought some Airbnb stuff.
Nice. Now, most of your properties, so how many do you own in total? A good amount, right?
Yeah, we have about 150 doors of properties. Most of them are in the Texas Panhandle and Amarillo.
Okay, so you have 150 doors, mostly in Texas. And one of the things that I'm excited to talk about is kind of the way in which you acquire most of yours, because I know, and it's cool because I have a little bit of an insight on what you do. You've made a shift from, or you're in the process of making a shift from wholesaling and flipping to just carrying and selling notes. So I want to get to that, but I also want to start with the acquisition of how you got those properties, because I think one of the things I love about real estate is the different ways you could do things, from cash to financing to subject to seller financing. And so you do a lot of the creative financing side. And so how many of those deals would you say like you got with creative financing? And then where did you really learn about creative financing to implement it? And then can you explain the mode in which you use it? So those are like 3 questions, but because
I think it's more 3 questions.
It might be. We'll just track together with it. But you've got 150 doors. How did you how did you learn about creative financing, and what type do you use?
I wouldn't say the majority of those were purchased with creative financing, but we have done a fair amount of creative financing over the years. We've done everything from single family rentals, Airbnbs, a lot of duplexes, quads, small apartment complexes. We have done one apartment syndication where we went and did a raise for that. And we've purchased a lot of properties with seller financing and subject to.
Okay.
When I first got started, I had this fourplex in New Orleans, and I thought, I love this business. This is so much fun. It was a nightmare trying to get that rehab done. But once it was done, I was hooked, and I wanted to do more. But then it was a problem of, how do I source deals, and what am I doing? Am I buying more rentals? Am I flipping? And slowly, I started building out new parts of the strategy and new parts of the business. Next thing you know, I turn around and I've got 15 employees that were doing 10 to 15 at a time. And I'll say one of my mistakes along the way was maybe not being as intentional as I should have in the beginning, because I spent a lot of time chasing different things and looking at what other people were doing and getting excited about their success and thinking, oh, that's so cool, I want to go do that. Last fall, we got to a place where I was running a business that I really didn't want to own. And for me, a lot of staff, a lot of overhead, a lot of marketing costs, focused primarily on doing wholesale, when in the beginning we had started as a buy and hold company, then we added on flipping, then we added on wholesale. So it was almost the inverse of the path that a lot of people start with, where they start wholesaling, then flipping, then buy and hold. We started in the opposite direction. And I took stock of all the deals that we've done over the last few years, and I pinpointed the ones that I thought were the most fun and were also the most profitable. And all of them involved something to do with creative finance. And I love solving those kind of problems. I love figuring out creative ways to offer on a property. I went and looked at a property this morning, completely overpriced. I'm going to craft an offer that maybe he'll accept, maybe he won't, but I can overpay for that property because I'm going to ask for some things in the terms that maybe he'll agree to, maybe he won't. But having the ability to craft offers that really do solve people's problems in ways that a cash offer can't is just so much fun. Yeah. And it ends up being quite practical when you look at the long-term value of these deals that we're creating, how much equity we're creating out of these deals. Now, it has to be balanced with some transactional revenue, because a lot of times we're buying these deals and we're having to put a little bit of money into it, or we're breaking even. We're not making any money up front. It's a long play because we're creating a lot of equity right there from the beginning when we're.
Yeah, and I think that's the balance that people run into or have to find when holding, right? It's the balance of like long-term equity versus cash flow now. Because if you don't have cash flow now, you can't continue to build the long-term equity. Now, I really loved when you talked about, and this is where I think like the entrepreneur journey comes in, because what I would assume is what happens is you start a business and then you go, you know what? I need to get around other people that are running this business well, because one, I don't know what I don't know. So it's good to get around a lot of like-minded people. And so you hear join masterminds. And that's how we met. We are in a really awesome mastermind that I would attribute honestly, I would attribute the success of my whole business to, which is incredible. But at the same time, super easy to do exactly what you said. If you don't have your intentions dialed in, it's really easy to get caught up in a business that caught up running a business that you actually don't like. And so for you, would you say that that came from joining the mastermind? And then how did you reorient that? Because I think it's a trap a lot of people get caught up in.
Yeah, absolutely. I think partly collective genius, the mastermind we're in, but more generally, I'm in an echo chamber a lot of the time where the content that I'm consuming is all real estate related. I'm in all these different groups, whether it's Facebook groups, Sub2 or Collective Genius or any of these other groups that I'm a part of. And it's dangerous when you only have inputs that are other people in your industry, I believe. And so I've taken a step back from the content that I consume. I try to get outside content and not just listen to real estate related podcasts, even though I know we're on one right now.
Nice.
But I do think it's important to branch out and not get tunnel vision, not be in an echo chamber, seek outside counsel from people who maybe are in other industries. The danger, I think, is to only see what other people are doing as the solution to whatever it is that you're trying to solve. And I'm a huge fan of what Paul Sparks and Steve Chang are doing right now with Certainty Talks, and I'm a part of the Whale Club. And this is what we talk about all the time, is having a solvable problem and working towards it and not chasing more. It's not about more deals. It's not about more and more revenue. We all have goals that we want to grow, but make sure that you know where you're going. Because I was just chasing more and more deals and really got myself into a job, created a job for myself that I didn't like. Two, put my financials in jeopardy because we were just chasing more and more and more. And all of a sudden we had huge amount of capital tied up in a lot of deals and maybe didn't have the systems and processes for the volume that we were doing at the time. So scaled it all the way back down to the beginning, narrowed our focus. We're not doing all the rehabs we were doing in the past. We're not trying to wholesale tons of deals every month. We're narrowly focused on what our goals are for wraps and creative finance, with a little bit of novations and flips.
Yeah.
Transactional.
Yeah, that's awesome. So what was that process like for you to find what you loved? Is it when you sat down, looked at the deals that you liked the most, what was the most profitable? Because I think more people than not, or more people than they'd like to admit or tell people, are stuck in that trap of the business makes money, but I'm miserable and don't know exactly what I love to do. And so for you, as you worked through that and navigated through that, what was that process like for you? Because I'm sure it was hard. You probably had to lay off staff. You probably had to introspectively decide on what you would start saying no to. You probably had to really narrow down your focus and put on the blinders. And so what was that time like? What was that experience in that season like for you?
It was really hard. When the market shifted last summer, the hedge funds turned off their buying instantly.
Yeah.
Now I didn't have, that didn't impact me. We don't really have hedge funds in my area. But I was thinking about this just yesterday, talking with someone, that I waited 4 months to start laying people off after that. Because those are real people on the other side of those conversations, people I care about, people that I invested in, people that I wanted to be successful. But all of a sudden I didn't want the same business that I had previous. The market had shifted dramatically. So I probably spent too long in that limbo space where I was thinking about which path do I go? And I did, because there's real people involved that I cared about. I don't regret waiting that long, but it was really hard. It was a really hard time. In terms of decision making, I believe that it's important to create time for self-reflection. I got myself into that situation because I was just go, charge, more. In order to get myself out of that situation, I had to stop and slow down and reflect on what we've done, because there was a lot of success in all of that too. We accomplished a lot in a very short amount of time with some really wonderful people on the team. And so even though there's maybe some failures in there, it's important to also appreciate all the successes that we've had over the last few years too.
Yeah, I love that. I think introspective kind of reflection is one of the most important things, because you have to make really tough decisions. Like, you have to, for the sake of longevity, for the sake of the health of your company, for the sake of actually having a company, you had to make hard decisions to lay people off and to do things like that, especially if they're either not culture fits or just financially you just can't support them. And I'm sure that season was hard as you honed into exactly what you wanted to do and what you thought would be the healthiest version of your company. So with that, I'd love for even just to talk into, okay, so then you double clicked on doing creative financing. Could you give like an example of what that is? Because a lot of people know, like, they hear creative financing, seller financing, stuff like that. What is seller financing, and maybe what's like the most common usage of it in your company that you use? And then I also may want to start talking about like notes, because you guys operate in notes and people have no idea what notes are. And
it's like its own little world.
Yeah, for real.
Creative financing can be anything that you want it to be. It's one of the fun things about it is that if you can get two people to agree on terms, you can do anything you want. If somebody wants you to pay them in goats, you can go pay them in goats, right?
Okay, really quickly, what's the craziest deal really quickly, like, you've ever structured then?
Craziest deal we've ever structured. One that was a home run was we bought 6 properties for $0 down, 4% interest, 30-year amortization for $100,000 purchase price.
Jeez.
And then we took each one of those and we went and wrapped each individual one to other investors, because they were all dilapidated properties that needed a bunch of work. And so we actually, without one deal, we created a little mini hard money loan company. And we're the hard money loan wrap 6 different properties by wrapping this underlying debt that we put on this.
Okay, so then you took the underlying debt of the 100,000 and you leveraged it and kind of like resold the properties to somebody else, and essentially seller financed it to other lenders or other investors. That's crazy. Seller financed the value of it with other investors, which essentially paid off your 4% 30-year note to this guy at $100,000, which is what, like $800 a month?
I was $450. I send him a direct deposit every month, and I get 8x that in return.
I'm sure. That's awesome, because you just sold it seller finance to them. They renovated, they're renting it out, and you're the bank to them. So that's essentially what seller financing is, right? Where the people own the property outright, and then they are the bank in that instance.
Yeah, and it works really great especially with tired landlords. The conversation goes really easily. Would you like to be upgraded from a landlord to a bank? And then we can talk about what that looks like. A lot of times we'll anchor them with whatever it is that they're looking for. What's most important to them. One of the things I love about creative financing is that it allows you to have more nuance in how you solve problems for people. So I can lead with, what is your problem and how can I solve it for you? What is it that's most important to you? And oftentimes we can give that to them, because in exchange for giving them what they want, we're asking for terms that are beneficial to us that allow us to cash flow or to create long-term wealth.
That's awesome. Now, do you do any subject to, like taking properties under subject to? Because I operate within a world where seller financing does not exist, because we do only foreclosures. So we do subject tos, where you do that as well.
Sure. Cool. We've done quite a few of them. Probably the first one was maybe 3 years ago. We have some specific buy criteria. We're a little bit stingier about how we buy sub-twos these days, but still a powerful strategy.
Okay, now why are you stingier these days on it? Because I feel like these days would be when you would want to double down on subject twos because of the interest rates that don't exist anymore.
Yeah.
But you're saying the opposite.
I think from experience, I've had one deal that I did with subject to that is not a great deal. And the reason it turned out to not be as successful is because there was very little equity. In the environment that we're in, my risk tolerance, and everybody has different risks, but my risk tolerance does not allow for me to purchase low to no equity sub twos for a couple of reasons. One, it limits your options for the exit. What I mean by that is it often locks you into a long-term hold as a rental because there's very few other options that you have for it. You can't sell it because you're in the same boat that the seller was.
Yep.
This solution works extremely well for a seller who has no equity, and if they were to go sell it on the open market, they would be out of pocket. And we can come in and we can buy subject to and just take over their payments. Oftentimes we're not even having to come out anything out of pocket. The best one I ever did, I gave the seller a $500 gift card to help with their moving costs. And I just took over the payments, painted it, turned it into an Airbnb the next day, and it cash flowed $800 to $1,000 every single.
Nice.
I think there's several things converging in the market right now that get me a little bit worried about subject twos, and maybe I'm a little contrarian about this, but I see all these people blasting out wholesale deals for sub twos that have no equity and no cash flow.
Yep.
And I am not going to buy those.
Yeah. And it's crazy. I saw one in the group the other day and it was like 15% down, all this stuff. I'm like, then why even sub to it? It doesn't even make sense.
Exactly. I think there is an elevated risk right now of due on sale. I think it's over. I think there's two competing thoughts. Due on sale is overblown. People shouldn't be as scared about due on sale clause as some people are. It's very rare to have a bank call due on sale. However, if the banks wanted to know all of their loans that had been sold, I think they could figure that out with the flip of a switch. These are billion-dollar companies. They could create the software to do that. They probably already have the software to do that. They choose not to because it's not in their financial interest to go and foreclose on a bunch of properties. However, if the delta between what they could be loaning those properties out for versus the 2.75% interest that they've got on that right now, if somebody creates a spreadsheet somewhere in a bank somewhere that shows, hey, if we want to go pull all these due on sales, we're going to make $100 million. Somebody's going to sign off.
Yeah.
And so the concern I have with low equity sub-twos right now is I think there is an elevated risk of due on sale if banks want to try to recoup that money that they have out there that's lent at 2.75% interest. And it limits your exits on the back end. So we look for sub-twos that have 20% in it for the things.
Okay, and 20% is a good number because I know some people that won't sub to anything unless it's 40% equity. And so 20% is good because even if the bank calls it due, you still have 60 days to sell the property.
Yeah, and we can sell it for a discount and try to get out of it. That's what we want. We have other strategies around that are a little bit more advanced, which gets into the note creation space. And so,
like land trust, do you have any of your sub twos in a land trust?
We haven't, but it's something that we will do in the future. In the past, I haven't worried about it that much, but I do think it's best practice to use a land trust, to always use a note servicing company. Those things are best practice.
Okay, yeah, that makes sense too. And just for clarity, land trust is when you take it and put the house in a trust. And so then the bank essentially is just, oh, this is just a family trust. It's not associated with your name. You are the executor and the beneficiary of the trust. So you own the deed on it, but the bank's not going to call it due because they just assume it's a house that's been moved into the family trust, essentially.
Yeah, you're trying to prevent the random bank employee who's looking up a name on the county assessor's website and it somehow triggers them to look deeper.
Yeah, that's awesome. Now, a little bit of a transition here, because part of this, when it comes to a lot of these sub two deals, especially with foreclosures like we do, and I'm sure you get some sub twos out of foreclosure, there are arrears that need to be paid off. There's this down payments that need to be made. There's all kinds of stuff like that. So for you, what's the main source of funding that you use to be able to do that? Because I know you and I have talked about raising capital and stuff like that, and you seem to be well versed in capital raising, which a lot of investors, once you get out of wholesaling, like, you need to start raising capital. That's just like almost like it's a non-negotiable if you want to be successful. And as a real estate investor, is not even using your own money, but other people's money. And so what's that journey been like for you? And even what does that journey look like in the future for you?
Yeah, I think it's the highest value activity that I can participate in for my company. To be honest, it's so important that I've put it as my top line item for this year and the coming year as well. It needs to be treated like it's its own job, and I haven't done a good job of that in the past. I think what I've also made a mistake with in terms of raising capital is having too many types of deals that we're raising money for. And so I think I've confused just some potential investors that we had, because, well, we were raising money for an apartment syndication, and we're raising money for our fix and flips, and then we're raising money for entry fees for our creative deals over here. And I don't think we've been as successful because we haven't been as focused on what we're raising money for up until this point. So my goal moving forward is to raise private money to fund all of the creative deals that we're doing, because the entry fees can't add up. We've got rehab costs, we've got closing costs, we've got money to the seller. And it's hard to go to institutional lenders and explain to them what we're doing. Yep. We don't really check a box on a form for most banks with what we're doing. It's too outside of the box.
Okay. Now, and this is, I guess, just in the nature of transparency. So I'm really excited. I think this is where our conversation becomes very conversational in back and forth, because I'm pretty far along in the capital raising side as far as formation and structure wise, but I'm not very far along in the amount, because I'm fairly new in it still. But structuring it and figuring all that stuff as far as a 506B and stuff like that, and going with a fund model or a fund of funds, just depending on however you want to do that. For you, you've been essentially doing deal by deal, almost like mini syndications without the paperwork type stuff. That's how yours has been structured. And like, how much cumulatively have you raised up to this point? And has it mostly been organic? So I know that's
sure.
Question.
So we've raised a couple $1 million, and it's all been organic, word of mouth, having conversations with people, trying to solve their problems, right? People who have extra money laying around that's not getting interest. We have a superpower in the real estate industry that we can give super high returns because it makes sense for our deals, right?
Yeah.
But we've done both sides. So we've done capital raise for investment, for syndications, or we've had lenders, right? And so it's important to make the distinction when you're raising capital and you're bringing somebody on as an equity partner. That's a very different thing. That's regulated by the FCC. We've got an SEC attorney, a retainer for those kind of things that we do. Whereas if we're talking about funding our creative finance deals or our fix and flips or things like that, those are lenders, and they have a promissory note and a deed of trust. They're in first position. They're the bank, just like any other bank, and it's a way more straightforward transaction. They have collateral. They're very, very secure. Our loan to values, I don't think we've ever had a lender that's higher than 70% loan to value. So they can. That's great. It's a simpler conversation than trying to raise equity for an apartment deal or something.
Yep. Yeah. And then it's easy. It's very transactional. Hey, wire the money here and do this. Now, when you first got started in that capital raising journey, what did you go to? Because I think in the beginning it starts out with friends and family. Then it goes to, do you have a certain niche, or do you find it to be mostly doctors or anybody like that? Or is it just people that you come across? And do you have a
Yeah.
pitch that's just, hey, I help people invest their money in real estate?
I think I'm probably pretty bad and disorganized with it. I need to learn from you to be better. But it has been a lot of friends and family, and also people who've just heard about what we're doing and are interested. I think those people want to be in real estate, but they're afraid to jump in and do what we do. And so they love being a participant, making money as a lender. They get to learn. I always make myself available to any of our lenders. I've spent hours answering their real estate questions. So there's a trade there that's not just money, but I'm also trying to impart some knowledge for them, because then some of our lenders have gone on to then do their own flips or buy their own rentals and things like that. They don't stay a lender for forever, because then now they got to go fund their own deals, but that's awesome.
Yeah. So that's what I was going to ask next is, do you ever partner with them? Because I have lenders now that are like, okay, we're looking now to invest into a rental property. And they've even asked me like, would you be able to manage it for us? And now I'm like, Link, I got to start a property management company. Like, sure.
Yeah.
But do you have lenders that ask you questions and then want to partner in with you on an actual flip and then help them to build their portfolio?
That hasn't come up yet, but I'd be open to it. I do a lot of JVs and partnerships with people. We have many different partnerships that we're doing. We're building JV partnerships with different wholesalers around the state of Texas and actually creating LLCs with them. It's not just one-off deals,
That's
but
interesting.
it's a part of our deal flow for our creative strategy is to partner with select wholesalers around the state of Texas, and they get to participate in our wraps and learn what we do on the creative side and on the note side. So they're excited about it because they now have new tools in their toolbox, because we're teaching them how to better close creatively and also giving them the underwriting models that allow them to make offers that they never thought were possible.
So this is really cool, man. I actually really love that you do this, because wholesalers typically get a bad rap from investors, from realtors, from the realty bar, from anybody. Like, they just hate wholesalers. But there's a lot of really good wholesalers that want to learn. And I love that you just specifically talked about partnering with them, because I think that's a really unique. Once you get to where you have funding and you are a buyer, I would love to hear what that partnership looks like. Is it like, thanks for giving us this property, here's a percentage of the profit, or here's your fee, you can then partner with us on what that looks like? And does that property stay in the LLC? I'm so curious.
Yeah, both are options. So if they want to assign it to us and we'll go to the wrap exit on it, we can do that. But for the guys that we really like and we want to be involved with long term, then we're creating an LLC and we're participating 50-50. So they're on the acquisition side, they're doing their own marketing, they're locking up contracts. They bring it to us and say, hey, this fits the buy box for what it is that you guys do. Let's throw it in this LLC. And then we take it over. We handle everything from there. So we handle all the TC. Your wife, Catherine, handles all the TC. And then Andrew on my team handles all the dispo, creating the wrap. And then if the deal requires it, we can also handle the note side on the back end, where we're buying and selling notes is another part of this.
Okay. Woof. Okay. So even just to clarify, when you're creating a wrap, so essentially you're buying the property. No. You're buying the property with cash, and then are you refining it out later? No. Yes, refiring it out and then seller finance. I'm trying to understand your wrap method here.
This is a really hard conversation to have on a call. You need a whiteboard.
That's true.
And a bunch of different boxes and arrows go in different places, but I'll try.
Which is something you're going to head into that direction and create a YouTube channel for all of this stuff.
I'm just trying to be like that.
You'd be going backwards, man. I'm trying to be like you.
So we can acquire properties in multiple different ways. Okay. So we can acquire with cash. We can acquire with a hard money loan. We can acquire with a private money loan. We can acquire subject to, we can acquire with seller financing. I believe that's 5.
Mm-hmm.
So depending on our acquisition strategy that determines what we do with it on the back end, but we can wrap any of those. So we've developed relationships with hard money lenders that will allow us to wrap their hard money loan. Of course, if we've got a private money lender, we can wrap that. That's what they're there for. And we can do
They would have to allow you to hold their money for 30 years.
Not necessarily. No.
Okay.
The way we've structured it in the past is for our private money lenders, they come in, they purchase the property, they can also fund the rehabs. They get interest-only monthly payments for however long they want, and then there's a balloon for the principal amount at that time. So they know that their money isn't tied up in the deal forever. We try to have a minimum of 7 years. Most people sell or refinance their house every 7 years. If, however, we needed to cash them out in 7 years, we have the option of selling the note on the back, which I'll kind of get to in a little.
Makes sense though. So now, but like, I think this is a good setup for the notes part. So this is good.
So we've taken one of these acquisition strategies to purchase a property. We then advertise it to an end home buyer with seller financing. The amount that we can get right now for a seller financing deal is about 11% interest. That's standard, right?
Wow.
And 10% down. We can also charge a little bit of a premium. We want to make sure that we're fair and ethical traders with our end home buyers. We're not trying to gouge them. These are the fair prices right now for interest for seller financing, because we're looking for penalty box buyers. So the people who have a good job, they've got a down payment, but something's happened on their credit that they can't qualify for a normal mortgage. About 50% of people who walk into the bank right now get decline the mortgage. They think they're going to get a loan and they get declined because they've got something on their credit. The banks are tightening their restrictions with what's going on in the larger market. It's very challenging for people to get a home loan right now. And a lot of people are W-2 employees. I got one guy who's a truck driver now, right? We got people who are immigrants to this country and they're hardworking people and they've got great jobs, but they don't have the credit history. Like they literally have no credit. How do they go get a loan at a bank? But we can look at them as a holistic person and say, you know what, this is a good credit risk for us. We can take riskier bets than an institutional bank can make. And so as compensation for those riskier bets, we charge a higher interest.
Wow. So you are taking deals, right? Off-market deals that we would normally try to wholesale. You're taking those down and you are creating a structure for them that enables a normal family to be able to long-term buy this property from you, and you're the bank essentially for people who wouldn't normally be able to get a bank loan.
Exactly.
That's awesome.
Deal that normally you would wholesale $10,000, and I'm creating $500 a month in cash flow and $40,000 to $50,000 worth of equity in it. And so you're maximizing your deals to a greater extent than if you did strictly
for the next 30 years. That's really awesome. So now that gets into like probably one of the last parts we'll talk about, but we could talk for hours. Right? But talking about this notes idea. So what you're doing now, then what you've done essentially is you created a note. Yeah. You've created a mortgage note that these people are paying on. And then you can do essentially, this is where people get confused and never know. Sometimes they're like, I have no idea who I pay my mortgage to. Or they're like, I don't know. I guess I'm getting foreclosed on because I didn't know who the new lender was. Because the lenders are selling notes, like we wholesale contracts essentially. Yeah. And that's what you're doing. So walk through that a little bit.
Yeah. There's different structures we can do on the note sale part. The one that we like a lot is creating what's called a first, second position. So when we sell the property to the end home buyer, let's use some round numbers and say we bought the property for $50,000. We were able to just do a cleanup. Maybe we painted it and we sold it for $100,000. We would then create a first position note for $70,000, 70% of the value, and a second position note for $30,000, 30% of the value. We could then go sell that first position note to an end note buyer. And this is a whole nother world where there's note buyers and there's note buyer podcasts and there's note buyer conventions and there's courses and there's gurus and there's all that stuff. And they are buying up notes either with their self-directed IRA, with their own cash, or there's aggregators. So they're going out and they're buying up notes, putting them into packages called tranches, and then they're selling those off to bigger buyers, family offices, hedge.
Yep.
So we're the base level of that. We're selling off individual notes to these other note buyers. What that allows us to do is get all our money out of the deal. So if we used our own cash or we used a private money lender, we could go in and sell off that first position note, get all of our money out of the deal. We maintain the 30% second position. We have an infinite ROI, and we have cash flow in perpetuity, and we have no risk in the deal because we have no money. So it's about deleveraging risk.
And you're still the bank. The note's still getting paid, and then you're still the bank. So you actually don't even now, but you are second position mortgage on the note. So if now the new owner goes and sells it, they pay off the 70% to the original or to the person you sold the note to, and then pay off the 30% to you so you're getting the cash flow, the 30% cash flow and appreciation.
No appreciation, just cash flow. Equity, value of the note is the value of the note. But if you look at how amortization tables work, in the first few years, you're mostly paying interest. And so the value stays incredibly high for a long period of time through the first 10 years. So if they ever sold or refinanced, you just get this windfall of cash at some point in the future, and you get a small monthly payment.
Because you're essentially getting paid your principal that they never even paid down because they've just been paying interest. Crazy, bro. You're a freaking magician. That's awesome. I love it, Jake. Man, Jake, I feel like we could talk for like hours and hours and hours on this. I know you wanted, we talked a little bit about capital raising and I love that stuff. And I know you wanted to dive in there, but I know we got sidetracked and started talking about some really awesome stuff. I would love to take maybe even like another minute or two if there's anything in particular you wanted to talk about capital raising, either like we could chop it up here for a minute, or if there's anything else you wanted to share that you think would be helpful for people learning or getting started in capital raising.
I think the first thing is I just have to be honest and transparent. We're always raising money for our deals, or always raising money for the entry fees on our creative deals. If anybody's interested in that, reach out to me and put my contact information. You get secured my first position, deed of trust, and a promissory note, and you get to learn about what it is that we do. And we don't hide anything. We're an open book. We share all the secrets. There's no secret sauce. And I'm always happy to share any of that. I think that's really it for me. What other questions do you have about creative or notes or anything?
No, I think that's great, man. I think I'm excited for you because I know you do a lot of deals and there's a ton of opportunity for people to jump into those deals, learn about them. And a lot of those deals don't require a ton of cash down. Those are probably anywhere between 30 and 70 grand that's needed to cover those deals. Well, no, sorry. So if you're doing seller financing, then you probably need something that's a little bit more in the 1s and 200s range if anybody has that capital. But also if you're sub-2ing, that is typically in that 30 to 70 range. So there's a wide range of capital that can be used here to help you out, which would be great.
Yeah, absolutely. I think one of the interesting things we've been able to solve recently too is the ability to give sellers a huge down payment, which most people don't realize that they can. But because we have those creative structures on the back end for how we sell notes, give sellers huge down payment. So there's a lot of deals that fit our model that other wholesalers are throwing away. So if you've got deals that you're throwing away with motivated sellers in the state of Texas, and we might be able to close the deal.
Boom. That's what I'm talking about. Get you some more deals. That's great. Okay, because you have no socials or anything like that yet, how do people get a hold of you?
I'll give you my cell phone. It's 806-340-1345. That's text me.
Don't
call me. I never answer my phone. It's always on silent. But text me and I'll check.
Boom. The man gave his cell phone number to the general public. Very awesome. He's ready. That means he's motivated and ready.
It's only back from
you.
Yeah, some weird ones.
I'm sure. Hopefully you don't get any weird ones, but actually people start shoveling you some deals. and shoveling you some cash, man. That is the goal. Jake, I appreciate you. I appreciate you and your time and who you are as a person, as a friend to me and my wife, and just very thankful for you, man. And thank you for being on today.
I appreciate it. I feel like we just scratched the surface, so we need to do it.
We will, because we did. Good, Jake, man. I appreciate you. I'm thankful for you being on, and I can't wait to see you again soon.
Yep. See you in Florida. Thanks, brother.
Yes, sir.